Good day, and thank you for joining Tyler Duncan Realty Partners monthly podcast on this Friday, October 25th. I'm Chad Tyler, and I'm here with my colleague, Charles Shapiro. Charles, you want to say hi to everybody?
Hey, everybody. Here we are. We're about to go into November, the last 2 months of the year. And think about this, Chad. How many times in our life have the Denver Broncos and the Washington, I was going to say Redskins, Commanders, both been relevant? Isn't this great?
This is awesome, man. It's been a very long time, so let's hope they can keep up this awesome winning streak. So we're glad you could join us today. Coming off the third quarter of the year, we thought it would be appropriate to give you a third quarter market update today. So we're going to focus on that. That's what we're going to do. We're going to cover the major commercial real estate asset classes. We're going to start off with office. Then we're going to go into industrial. We're going to cover retail, and we're going to cover multifamily. So I'm going to start us off with the office sector. I'm going to focus on primarily the Washington, D.C. market for each of the different asset classes. And then Charles will focus on the Denver market. Those are the two markets that we're most active in. So looking at the office market, just from a national level, right now at the national level, we're seeing vacancy rates at 13.9%. That's pretty much a record high nationally. And with the DC market, we're seeing vacancy rates at 17.4%. And that's among the highest in the country. And similar to that, Denver right now has a market vacancy rate of 17.1%. Again, one of the highest vacancy rates in the country. As we look at some of the major trends throughout the U.S. in the office market, we think that the market is close to bottoming out, but it still continues to be a slow roll, so to speak. Demand is still pretty flat. We are seeing more companies, more employees coming back into the office. There's a slow, steady rise of employees returning to the offices. Companies moving out of space has slowed a fair amount. And the lease deals are getting done, but the average size of the lease deal is about 20% less than pre-COVID. In addition to that, the construction pipeline, not surprisingly, with very sluggish demand and high vacancy rates, the construction pipeline is way down, significantly down, and continuing to reduce. Right now, the current under construction inventory is at about 2013 levels, and it's continued to be expecting to shrink further. So right at this point, we're still expecting the vacancy rate to rise through 2026 and rents to remain flat and even declining some through 2026. But let's drill down a little bit closer to the Washington, D.C. market specifically. So right now, over the last quarter in the Washington, D.C. market ending September 30th, we saw 6.2 million square feet of negative absorption. So that means that more space came to the market with 6.2 million square feet coming to the market. The 17.4% vacancy rate we're seeing right now is amongst the highest we've seen in the Washington, D.C. market. And the leasing activity right now is about at 25% of pre-COVID levels. In addition to that, rents have flattened out and declining some, falling back to 2018 levels. And some of the concessions that we're seeing are very aggressive, usually about 2 months free for every 1 year of the lease. In addition to that, right now, construction is at a 30-year low. And that coupled with some of the conversions of office to multifamily is going to help shrink the inventory and hopefully speed up the recovery some. But at this point, the slowdown in office space, it's still going to be long-term. The recovery is going to be long-term, well into 2026. Looking at investment sales, and we're going to get into some of these charts in a minute with a little bit more detail, but they're looking at investment sales over the last 2 months with $2.7 billion in sales. That's about 70% less than the pre-COVID averages. And not surprisingly, just with the very challenging fundamentals with the office market, it's hard to get these deals financed, and also higher interest rates are playing into that as well. Let's get into some of the charts. Look at the first chart, which is shows net absorption, net deliveries, and vacancy rates. And we're going to look at some additional charts that break out some of these components individually in more detail to provide a little more clarity. But looking at this chart right here, you can see that looking at 2024 going forward, again, we're expecting negative absorption well into 2026, like all the way up to 2027. And then in addition to that, vacancy rates are still rising. The Washington, D.C. market is shown in green, and you can see it's considerably higher than the yellow line, which is the national market. Let's drop down to the next chart, which is the vacancy rate broken out by itself. And here, this depicts vacancy rates among different classes of office property. So you can see the orange line is 3-star properties for the Washington, D.C. market. The blue line is 4 and 5-star properties. And you've got the blended rate, which is the green, Washington blended amongst the different classes of office. And then you've got the U.S. again in yellow. So I think the important part here is if you look back in 2019, that was kind of the trough pre-COVID of the vacancy rates. Not great rates, but certainly better than where we are now. But more importantly, if you look at 2024 and beyond up to 2028, you see the vacancy rates continue to rise up until about 2027 and then flattening out from there. So again, we still have some considerable time to get this market back to some stability. Moving on to the next chart, we're looking at market asking rent growth. And somewhat ironic here, obviously it's a very soft market. And so the chart does depict, some rent growth, but the fact of the matter is this reflects more asking rents versus what deals are actually getting done at. So we're certain that the deals are getting done a fair amount less and not likely showing actual rent growth in terms of the actual leases rents being negotiated. So if we look at the rent growth, through the end of 2024, we see it's kind of flatlining there throughout 2024, and then expected to dip down further into 2025, kind of a trough at year end 2025, and then starting to increase after 2026. And I should mention that one of our leading data suppliers is CoStar, among some others, but a lot of these graphs and charts we've secured from our CoStar relationship. So moving on, looking at deliveries and demolitions, the big thing to take away here is that if you look at the last 5 years, going back to 2019, you see some pretty healthy inventory levels. It takes a long time to get these properties to market when they're being developed and in the pipeline to the approval process. So there's a fair amount of inventory pre-COVID teed up. Then if you look at 2024 going forward, you can see that deliveries are expected to be way down, which makes sense given the softness of the market and hopefully will again help the market recover sooner. Moving on to our next slide, we're looking at sales volumes and market sale prices per square foot. And not surprisingly, sales volumes are down considerably. You can see we kind of hit a peak in 2021, but we're way off those numbers here in 2024. In addition to that, sale prices per square foot are way down. You're looking at, in 2021 up around an average of 360 a foot versus 260 a foot right around 2024. And a lot of, some of these sales more recently have been more distressed sales. And as we've mentioned in prior presentations, and as we've talked about in prior presentations, we're expecting that the inventory of distressed sales to increase, and we're seeing that in actual fact right now. So these numbers are likely to go lower and will not start recovering until 2027. So with that, Charles, anything before I'm going to have you talk about the Denver office market, but anything you want to add to on the Washington?
Yeah, well, first off, looking at this graph, you're going to see this same graph pop up for all the product types. So that is a factor of the increased interest rates, as you said, and the cost of owning any real estate has gone up so much. So we saw this across the board, but we really see this bifurcation between, say, industrial properties and multifamily properties who are performing basically to a market cycle. You can understand why, there might be a slowdown in industrial, why the vacancy of multifamily is higher in Denver, but you see it's going to get worked through. There's real uncertainty. That's the other side of this on the retail side and the office side, because we don't know how long is it going to take for employees to come back to the office. We also know that Denver and Washington were two of the worst performing office markets because you have a lot of high-tech workers in those markets that can work from home. They can make those demands and their bosses will say, yeah, that's okay. And so there's this uncertainty. Well, when are we going to get back to normal, or are we going to just have a new normal going forward that we have to plan for? So it's really, it's a very interesting concept. So now moving towards to Denver. So what I just said was Washington and Denver are performing very similarly. So Denver's vacancy rate is 17.1%. Washington's is 17.4%. If you had a list of the major markets around the country, they're very much the same. Denver and Washington are really right there at the top. We also talked about the fact that companies that are renewing their leases are doing it for smaller spaces. Nationwide is 20%. In Denver, 42% less space on the average when they're renewing leases. And that's huge. And it's a big challenge for developers. In Denver, where we're seeing is a real flight to quality. So you have companies that want their people in the office. Well, what they're trying to do is entice them back in the office with great amenities like great food, health clubs, things that will make them want to come to the office. So these are high quality, more expensive properties. The Class A minus properties are doing terribly. The Class A plus properties are doing really well. And just like we said in DC and nationwide, the concession packages are a lot better. There's more build out, there's more free rent. And as we saw, and what we're going to see again and again, is that investment demand is down. And that should end up going back up when we start seeing the interest rates going down, the cost of owning real estate go down. So here what we're seeing is the same thing we saw in DC. What do we see happen to vacancy? It's going to be going up for the next few years as they chunk through more and more inventory and more people start coming back to the office, but it's still going to plateau at a high rate. There's no expectation of vacancy rates shooting back down. And over here, market rent growth. Now, DC saw a bigger trough going down in 2025, 2026. And one of the reasons why you're seeing this negative rent growth is you're actually getting it now. Deals are being done at lower rates, but they're not publicizing lower rates. No one's lowering their asking rate. The brokers know that if they're asking 45, I know I can get 38. I know I can get 37. But what we're going to see is as more properties, distressed properties, get back onto the market, the owners are going to advertise lower rates. And that's going to force everyone else to advertise lower rates. And that's why we see this trough coming along. In deliveries and demolitions, the lines that you're seeing, the black lines, that is net deliveries of space. So in the first quarter 25, there's going to be a big delivery of space. And after that, it's really low. Now, when we say big deliveries of space, that's going to be about 500,000 square feet. And then after that, it's really going to be low, just like in DC, where there's actually less coming onto the market. So hopefully they will be recovering more quickly. But in order for us to chop through this, we got to make sure that that we're not having to battle against new properties coming onto the market. The Denver office market, this looks exactly the same as DC, and that's what we're seeing across the board in terms of the fact that that the price decreases should be going down in the next year, and then recovering over the next few years. So, Chad, we're going to go back to you for the industrial market.
Sure. Before I hit on that, Charles, I would just add that, similar to Washington, D.C., Denver has made a concerted effort in trying to encourage some conversions of office to multifamily where it makes sense. We had mentioned in prior presentations about some tax incentives for that. So there's been some success there, but right now, Washington, D.C., leads the nation in terms of the highest level of conversions. But Denver is focused on that and starting to make some headway there as well.
And when you
So,
see
as
that,
Charles
Chad,
mentioned, we're going to switch gears.
You're going to start seeing demolitions, because in the statistics that we get, if a building converts from commercial to residential, it will be considered demolishing the commercial building, even though it's not physically being demolished, and then a new residential building.
Good point. Thanks for making that clarification. So we're going to switch gears, talk about the industrial market, both for the Washington, D.C. area, the national market, and Denver. So looking at the national market, right now we're at a vacancy rate of 6.8%. So pretty high nationally, looking at the last several years. Looking specifically at the Washington, D.C. market, currently we're at 5.3% for the industrial market. And looking at Denver, we're at 7.5%. Again, focusing on the national market, for the last 9 consecutive quarters, we've seen increases in vacancy rates. We've also seen the net absorption level at its lowest level since 2012. But that's stabilized, and that trend is currently kind of flattened and hopefully rebounding here soon. We do expect recovery should be around the corner for warehouse and industrial properties. We've seen that with employment in that sector increasing. And we've also seen year over year rent growth that has increased by 3%. And we've seen warehouses, in terms of the level of inventory being added to the market, slowing down and tailing off. So in certain markets, and we'll talk about Denver and Washington in a second, but in certain markets, there is still a fair amount of pipeline teed up, which is going to keep rates flat overall. But the market in general is healthy. Charles alluded to it earlier that we've had a very strong industrial market for the last several years and just a short period of cooling off. So looking at specifically the Washington, D.C. market, right now, over the last quarter, vacancy rates have increased by 140 basis points. And this is largely a result of some slowing absorption and increase in supply coming to the market. But the rate is still pretty low at 5.3%. In addition to that, with the DC market in particular, there's been a focus of data center construction, which has really helped that market considerably over the last several years. In fact, since 2020, nearly 40% of all supply in the Washington, D.C. and extended metropolitan market has been made up, about 40% of it's been made up of data centers. Northern Virginia being the data center capital of the United States. So with, there's been an added supply of since 2022 and in 2023 of 6 million square feet in the Washington, D.C. and extended metropolitan area. So that's kept the vacancy rate a little bit higher than it has been, but still a very healthy number at 5.3%. So rent growth has continued to post positive numbers for the last several years in the industrial sector, but it has slowed to 4.2% trailing annual rate, and that's down from 10.5% a year ago, which 10.5% is a very strong, probably historic record high level of rent growth. So we do expect with inventory in the pipeline of new product coming to market, we're expecting the market to tighten up and the vacancy rate to stay low and rental rates to to start maybe climbing up a little bit more than that 4.2%. So let's get into some of our graphs and charts. Let's start off with the net absorption, net deliveries, and vacancy. And just as you can see, looking back to like 2019, you can see that we've seen really high net absorption with the orange bars, and then high net deliveries with the blue bars. And with the vacancy rate, you can see that we kind of hit a record low vacancy rate right around the end of 2022, the beginning of 2023. And then it's increased since that time, fairly significantly, but still a pretty modest number overall. And again, still a healthy market. But if you look at from 2024 going forward up to 2028, we're seeing that vacancy rates are going to flatten out, trail down, and we've got considerably less inventory coming to market from 2024 through 2028 as compared to the prior 5 years. So moving on to the next chart, which is the market asking rents, rent growth, showing rent growth. Again, you can see right around 2021 into early 2022, we saw the rent growth peaking out in those years, and then trending down since that time into 2024, currently where we stand now. However, they're looking to early 2025 flatten out and maintain a decent level of positive rent growth. As we move on, look at deliveries and demolitions. We mentioned this a little bit in prior slides and prior comments, but similar to really night and day in terms of the healthiness of the markets, but similar to the office market, there's less inventory coming to the Washington, D.C. and extended metropolitan area as far as industrial product. So the next 4 years projected in terms of what's in the pipeline, what's sort of known in the approval process, is considerably less than the prior 5 years, which again is going to keep rental rate growth growing and keep vacancy rates lower. Looking at sales volumes, you can see that similar to the rental rate growth and the low vacancy rates, saw sales volumes peaking out around 2021 year end into early 2022, with the industrial market being so strong for so long. Been a lot of interest from investors in the industrial market, but there's not been a ton of supply being brought to market. And so you can see that while the sales volumes are down a fair amount from 2022 now to 2024, the price per square foot in terms of where deals are selling at has been trending higher over that period of time, at least flat and now trending higher kind of year end 2024, projected into 2025, 2026. And again, that's a function of limited inventory. So Charles, why don't you pick it up and talk about Denver, or if there's anything you want to add about the Washington, D.C.?
Well, yeah, the first thing that's very interesting is we saw how the prices for office has been shooting down. We didn't see that decrease in the industrial market. You sort of saw the prices stay flat, which is what you would more expect with a healthier market, even though there are headwinds caused by the high interest rates. The other thing that I find really interesting is the fact that DC is such a big data center market. I mean, these are very expensive buildings to develop. So, there's got to be a lot of confidence that they're going to be able to keep that space leased up in the future, whereas Denver is more reliant on the logistics companies, the Amazons and the Walmarts, who have taken millions and millions of square feet. There's very different types of product and very different dynamics. But moving on to Denver, office was at 17.1%. The vacancy at 7.5% is among the highest in the country. Now, the Denver market has been a killer. It's been amongst the best. So I'm not really worried about the 7.5%. We're going to expect the vacancy to stay elevated through the beginning of the year. We've had a big construction boom in the last year, and we have still 4.4 million square feet that's available. But Most of it will deliver by the end of the year, and we're going to expect that pipeline of new construction to go way down. We think rent growth is going to stay tepid, like we talked about in the DC market, at around 2% as the market works its way through the new supply. If that gets leased up quickly, then you're going to start seeing rent growth really pop back up, vacancies go down. And in Denver, we're starting to see more of a demand for small bay properties. And so we expect that you're going to see the performance of small bay properties go up as vacancy rates go down and rental rates go up. So over here, we're seeing, again, what you saw in DC. We expect vacancy rates that have been going up to go back down. But you see, we're talking about going up to maybe 8% and then shooting back down very, very quickly. You're also seeing the supply, which you see on the right in the forecast, that it's going to be tepid. And when you see the blue line and the orange line line up the same, that means that supply and demand is pretty much equal. And so we're seeing more net absorption predicted than we're seeing new supply, which is what's going to bring that vacancy rate down. Asking rent growth. So we're seeing it really around 2%. The specialized property, by the way, that's what would be if we had a lot of data centers. That's under the data center area. But we're seeing rent growth get tepid. It's going to go back up to that 4.5, 5, maybe even touch upon 6% as we eat through the supply that's on the market. We saw this a little bit earlier. I like to show the demolitions in here and the net deliveries, but it's all going to be under 1 million square feet a quarter. It's going to be very doable for the Denver market. And finally, this might as well be the same graph as we just saw for DC, where yes, we saw a trough, but you're seeing a rebound in investment in warehouse. Because guess what? If people are going to be looking for investment properties, they've been looking for it in warehouse. That's been the safest market to be in. And we're going to see the prices per square foot go up at what we consider to be a healthy rate. Chad, anything you want to add before we roll over into retail?
Yeah, with the Denver market, I think it's worth noting that the path to bringing supply to the market is a lot shorter and easier than the Washington, D.C. and extended metropolitan area. And it's for a lot of different reasons. There's more availability of land. The approval entitlement process tends to be quicker. So that's played into the excess supply in combination with there's been a long-term strong demand there. So that's both of those factors have played into the excess supply there. But again, overall, as we've said several times, it's a long-term, it's a very healthy market. A lot of factors that will continue to support strong industrial market in Denver, and of course, the Washington, D.C. and extended metropolitan.
Let's go into a real different dynamic in the retail section. Look at those vacancies.
Absolutely. Yeah, so switching gears to the retail market, looking at the national level, right now we're at a vacancy rate of 4.1%, very low. Washington, D.C., similar, we're at 4.3%. And then with Denver, we're at a 3.8% vacancy rate. Some of the trends at the national level include, right now the market is really about as tight as it's ever been in the resale sector. And vacancies continue to be at historic lows. Most active sectors include the food and beverage sector, discount, off-price, and experiential sectors driven out, over the new leasing in 2024. Those sectors have driven a lot of the leasing in 2024. So, we are seeing some pullback in terms of tenants moving out, which happened during COVID. That subsided considerably, which obviously is positive. Right now, a lot of the new construction you're seeing in the retail sector tends to be build to suit. So we're not seeing big, huge retail centers. We're seeing some big box type power centers, but a lot of what's being put up right now, is build to suits. Right now, retail rents continue to rise at a healthy pace due to the new average, with a high average of about $25 per square foot. And that's nationwide. And construction nationwide remains pretty limited. And it's a combination of several factors. I mean, number one, finding great sites is a little bit more difficult these days. Also, there's some concerns about the competition from e-commerce. That's always been a long-term concern for the last several years. It hasn't come to bear quite as much as people have expected, but it still is a concern out there. In addition to that, we also have high interest rates that are playing into that. And there's been some trepidation about the overall economy, which is all it played into less retail projects, coming to the market. Switching gears, focusing specifically on the Washington, D.C. retail market. Right now, we're seeing an availability rate at 4.9%. That's about the lowest we've seen in 16 years, which is a huge positive. Rent growth is a healthy 3.5%. And giving low construction and absorption, right now we expect the DC market to continue to remain strong for the next several years. Right now, the urban core in the Washington, D.C. market has about 8% of the retail space available for lease. So that's much higher than the suburbs due to some pandemic fallout. In addition to that, the market remains stable with a balance between supply and demand expected for the next several years, as we've indicated. Getting into some of our charts, we're going to start off with net absorption, net deliveries, and vacancies. Right now, if we look at similar to the industrial market, net absorption and the high point for deliveries was right around 2021. And we've trended down, for the most part, we've trended down into 2024 from those numbers, although 2022 also showed a big number as far as net absorptions. But if we look at the demarcation point from 2024 forward, the dotted line going to the top of the chart to the right, you can see that net deliveries are slacking off considerably. So that's just going to keep vacancy rates low, keep rental rates strong and growing. We mentioned earlier some of what's playing into the curtailing of inventory coming to the market is the e-commerce concerns, competition there, and the other factors that we mentioned earlier. Switching gears, if we look at market asking rent growth, you can see that from 2023 into 2024, we saw some dip with asking rent growth, but still a very positive number in terms of rent growth and a pretty modest dip. And then it's going to jump back up through all of 2024 year to date. And we're expecting that to increase higher into 2025 and then seeing some trailing off towards year end 2025. But still positive rent growth numbers and so remaining stable after that. Moving to our next chart, which is deliveries and demolitions. Again, we can see that from the prior 5 years, looking at 2019 up to 2024, they're pretty decent numbers as far as deliveries versus looking forward up to 2027, much lower numbers in terms of deliveries. And I mean, these are, just to put it in perspective, these are quarterly numbers. The bars are quarterly numbers, and these are very low numbers for the Washington, D.C. and the extended metropolitan area. It's a very large market, but if you look at like early year-end 2024, early 2025, and we're projecting about 200,000 square feet per quarter being added to it. So again, very low numbers. The switching gears, looking at sales volume and market sale price per square foot, similar to the industrial market, with the retail sector being so strong, there's been a lot of investor interest in the market, and investors, they're looking to buy retail centers, but the inventory has been very low. So we've seen the level of sales volume decreasing. You can see kind of peaked out 2021, dropping down into 2024. But sale prices, similar to the industrial market, have trended up And we're showing a slight dip in sale prices into 2025, 2026, but then a quick recovery thereafter. So, Charles, why don't you pick it up and talk about the Denver retail market, or if you have anything to add to the Washington, D.C. market?
There's so many sort of similarities just by the fact that developers have no confidence in building large retail. There's obviously no confidence in malls. The most successful malls are the ones that are the highest quality in the best areas, and everything else has really been problematic. So they're trying to figure out what to do to get people to buy from brick and mortar, and it's certainly not easy. So, but rolling into Denver, just like DC, the availability rate is super low at 4.7%, and the vacancy is 3.8%. So availability is how much space is on the market. Vacancy is how much space is actually vacant with no tenants in it. So the low availability is impacting leasing activity. If there's no quality space there, you're not going to have leasing activity. And that's the thing. Most of this space is in lower quality product. So a really good retailer is not going to want to go there. And that's really one of the challenges are. So in terms of what is driving the market, national chains, convenience stores, banks, they're the ones that are driving the leasing activity. Construction projects are dominated by, just like we talked earlier, single tenant build to suits. I mean, a lot of the bigger tenants are choosing to build on pads and maybe not be a part of the center itself, but be separate from it. So rent growth, even with the fact that we have this minimal construction and very little vacancy, rent growth is very, very low. It's at 2.1. We expect it to go negative, and adjusting for inflation, the rent growth is negative. So even though the fundamentals are strong, leasing activity is down because there's nothing to lease. And the stuff that is to lease are in lower quality centers, or in the poorer neighborhoods or what have you. And it just makes it difficult for anyone to demand larger rents. And just like in DC, investment activity remains muted. And really the buyers in Denver have been the smaller private buyers that are buying triple net properties, which is, a lot of companies have their mainstays is buying a Burger King that's just going to just turn into an income stream for them, and they don't have to do anything else. So the scary thing over here is looking at the vacancy, which is low, and it's not going to go up by much because there's just nothing that's being built. And that is the big takeaway over here. It's going to say the vacancy is going to stay low because there's nothing else out there. Rent growth, you see where rent growth is at 2%. That's where it's going to stay. It's 1%. It may turn into 0, but it's going to stay muted at best. Deliveries, and this is, I wanted to say about DC. If you go to the left-hand side, you're talking about 200,000 square feet is the first bar. But if you look at these crossbars, you're seeing negative deliveries through 2025 and nothing. I mean, really, the net increase is going to be nothing over the next 4 or 5 years. And on the investment side, this looks just like DC, where we've had slowing investment volumes. The prices should come back in the next year, especially as interest rates get lower. But the challenge is going to be figuring out what to do with larger properties. Is there real growth in some of the larger properties and what it's going to be? And so the one thing that I found interesting is that retail developers and retailers are the most creative group out there in real estate. And so they're going to figure out something. So it'll be interesting to see what happens to these properties over the next 2, 3, 4, 5 years. So now, Chad, anything else you want to say about that before we move on to multifamily?
I would just point out that in the Denver area, the Cherry Creek market in particular continues to be a real standout. I mean, the whole market is great, very healthy, but that particularly is a standout in terms of having, the best fundamentals, so to speak, of the Denver market. So,
Yep.
So we're going to switch gears and wrap it up with the multifamily sector. And looking at multifamily on a national level, right now we're at a vacancy rate of 7.9% versus the Washington, D.C. metropolitan market with a 6.8%, and then Denver, which is at 10.3%. Some of the major trends at the national level, the third quarter saw a strong rebound in demand for apartment units across the country on average. There were 450,000 units absorbed year to date through September. This is the highest and the strongest performance since 2021. And demand is in part due to the high cost of ownership. We all know that the cost of buying houses has gone up considerably and has not subsided very much. So right now, the apartment market is moving to a more healthy balance between supply and demand. In the last couple of years, supply has outpaced demand for the last 3 years. But we're seeing that come back into balance right now for most markets, most major markets. Rent growth overall at the national level has been a tepid 1%. And this is mostly in the higher quality properties where we're seeing, most of the rent growth taking place. Focusing on the Washington, D.C. market, not surprisingly, the Washington, D.C. and extended metropolitan markets is one of the biggest multifamily markets in the country. And over the last year, we've seen a higher level of rent growth than we've seen at the national level. So it's been 3.2% for the Washington, D.C. and extended metropolitan area. We've seen absorption over the past year at about 15,000 units. So that's higher than the national level of absorption. Looking at Northern Virginia in particular, Northern Virginia has the lowest vacancy rate, the Washington, D.C. metropolitan area at 5.2%. Maryland's shown a vacancy rate of 7.3%. So it's slightly elevated due to new supply having come to market in Maryland. Right now, there's 24,000 units that are under construction, and 40% of those are in the District of Columbia. So that may play into less rent growth going into next year, a little bit higher vacancy rate, but overall still a very good market for the district. And right now, looking at construction in the pipeline, we're seeing a fair amount less in the pipeline than we've seen for the last 5 years. And that's going to help the market continue to remain stable and maintain decent levels of lower vacancy rates and rents stable as well. We're getting into some of our charts, looking at the absorption, net deliveries, and vacancy. The Washington, D.C. market is in green. The national market is in yellow, similar to the other charts. You can see that Washington, D.C. as compared to the national market is faring very well. And you can also see that looking at the prior 5 years, going back to 2019 versus the current year, and then projecting through 2028, scheduled deliveries are down considerably. And that's a function of having been oversupplied a little bit in prior years, and some of that construction trailing off, as well as elevated construction costs, which are dampening some of the new deliveries in terms of bringing them to the market. Looking at market rent growth, we can see that the market rent growth peaked out right around year-end 2021, early into 2022, and kind of through most of 2022. Is at a very high level, dropped back considerably into 2023, but then has been trending up since that period of time. And it's projected to continue increasing through pretty much all through 2025, and then slowing down a little bit thereafter, but still positive rent growth numbers. Moving into Deliveries and demolitions. We've mentioned this a few times. Deliveries for the next 4 or 5 years that are in the pipeline will be a fair amount less than we've seen in the prior 5 years. So we see that, right around 2021, we're looking at deliveries of about 5,000 units per quarter. We look at going into 2025, we're more around 3,000 or even a little bit less than 3,000 units per quarter. You look at sales volumes and market sale prices per unit on the next chart. Similar to the other metrics, we see that sales prices per unit peaked out at year-end 2021, early 2022. They've dropped down through 2023, started to climb back up in 2024. And similar to the retail and industrial market, there's been a lot of interest, in the multifamily market from investors. And as a result of that, we're looking at prices per unit starting to climb back up rapidly into 2025 and 2026. Charles, anything to add to the Washington, D.C. Multifamily market before you talk about Denver?
It's interesting looking at this particular graph. And it's like you look at it and it's, well, there aren't a whole lot of sales there. Well, the first line is $1 billion. And it's, so people have to, you got to look and see, well, what does this chart look like? Because you can make it look like a lot or you can make it look like a little. Washington, D.C. is an incredibly healthy multifamily market. I think that's the bottom line, is that it's healthy and it's going to remain healthy. So moving on to Denver. Denver's another healthy market. Now, you wouldn't think so with a 10.3% vacancy rate, but there is a huge amount of demand for apartments. But at the same time, the construction pipeline is even more active. There's 15,000 units that are under construction right now, which is more right now than was under construction in DC, which is a bigger multifamily market. So even though apartment demand is higher, it's not meeting up with the increased supply. And because of that, rental rate growth is negative right now. And with, when you add into that inflation, it's even lower. But that's that big balancing act. And in apartments, that, rental rates can change very, very quickly depending on where they see the market. They will raise their rents, they will lower their rents very, very quickly. As with DC, new construction has plummeted because of the costs and because of the supply situation. And we expect in 2025, rent growth will start growing a little bit more rapidly. So here, look at the top line vacancy. We expect it to top out at the end of the year and then start coming down to a more comfortable area. But you can see on the left side of the dotted line, all those blue bars are net deliveries, and under that is net absorption. So because there are more deliveries and absorption, that's why you've seen this vacancy rate go up. And the expectation in the future is a balance, not a lot more absorption. So let's just say housing prices shoot up even further. Then you would expect to see more absorption. We don't expect to see it that way, and vacancies will come down. But we expect vacancies to come down slowly as there's more of a balance between supply and demand. Now, looking at here, this is something I wanted to explain. Every time we look at these charts and you see this sort of stair step increase in rental rates, and the reason for that is that most of the increase in rents come at the beginning of the year, in the first half of the year, and then it flattens out in the second. And so you see these little stair steps where it goes up, stays flat, goes up, stays flat. And that's what you're seeing here. So rent growth going lower, going negative, and then we expect once they've chewed through a lot of the new supply, that rent growth will be much, much healthier. And I fully expect the same thing to occur because Denver is a very healthy market. net delivery. So you can see that it's going to be going down. It's going to be going down to levels that we haven't seen in at least 5 years. And again, that's understandable. And once vacancy rates start going down, you're going to start seeing construction, go right back up. Sales volume, prices have been going down. We expect that to change in the next year. And, sales volumes with interest rates going back down, again, like with the other product groups, we expect to see more volume in that part of the market. But I think that I'm going to send it back to Chad for his final comments. But, we see this very healthy apartment market, multifamily market, where the supply and demand is really in balance. And the same thing with multifamily, but office and retail, which are real question marks, they're not going to be responding the same way. So, Chad, what are your thoughts on what we've been talking about? Your final thoughts?
Sure. Just in terms of a wrap up, focusing specifically on the Denver market, the Denver market has just seen explosive growth in population for like the last 10 years. It's been amongst the top 20 highest growing markets across the country for the last several years. So that kind of plays into the high supply and the bigger pipeline there on the multifamily sector that we've seen. But that's kind of ironic because a lot of people think that Colorado overall is growing at that level, when in actual fact, it's the population growth overall throughout Colorado has been more muted, and a lot of the growth has been concentrated in the Denver and extended metropolitan market. So as every month, we appreciate you taking the time to join us for our podcast. We hope this information has been helpful to you, and we look forward to you joining us next month. If we can be of any further help or answer any questions that you might have, our contact information's on the slides here, so don't hesitate to reach out. Otherwise, we look forward to catching up with you next month.
Take care, everybody.